When Japan intervenes to support the yen, it can look like a technical market event, the kind of thing that belongs on a trading desk rather than in a wider discussion about power, decline, and global risk. A currency falls too quickly, officials become uncomfortable, the authorities sell dollars and buy yen, traders adjust their positions, and the exchange rate moves. On the surface, it seems like a financial plumbing story. Beneath the surface, it raises a much larger question about Japan's place in the global economy and whether the tools that worked in the past still work in the world Japan now faces. The phrase most people use is Bank of Japan intervention, but that phrase hides an important detail. In Japan, foreign exchange intervention is decided by the Ministry of Finance, while the Bank of Japan carries it out as the ministry's agent. That distinction matters because this is not ordinary monetary policy. This is the Japanese state using its financial power to defend the value of the yen. It is not simply moving interest rates or giving guidance to markets. It is entering the foreign exchange market directly, usually by selling dollar assets and buying yen, in an attempt to stop the currency from falling too far or too fast.
That can be effective, especially in the short term. A sudden intervention can punish speculators who are betting against the yen. It can force traders to close positions. It can remind markets that Japan still has one of the largest pools of foreign reserves in the world. It can change the mood for a few days, and sometimes that is exactly what officials want. Intervention is partly about price, but it is also about psychology. It tells the market that the government is watching, that the exchange rate is not being allowed to move without resistance, and that anyone treating the yen as an easy one-way trade may be in for an unpleasant surprise. The deeper problem is that intervention does not remove the reasons why the yen is weak. It can push against the market, but it does not automatically change the incentives that created the trade in the first place. For years, Japan kept interest rates extremely low because its economy was stuck in a long struggle with weak growth, low inflation, aging demographics, and heavy public debt. The United States, by contrast, moved into a much higher interest rate environment. That difference gave investors a simple opportunity: borrow cheaply in yen, convert into dollars, and buy higher-yielding assets. This is the carry trade, and while it sounds like a piece of financial jargon, the basic idea is very simple. Money moves toward where it is paid better.
That is why Japanese intervention can become dangerous if it is used as a substitute for solving the underlying problem. If Japan sells dollars and buys yen, while interest rate differentials still reward yen weakness, the market may retreat briefly and then return. If officials intervene again, the market begins asking a more dangerous question. It stops asking whether Japan can intervene and starts asking how many times Japan is willing to intervene before the cost becomes too high. Once that question enters the market, intervention changes character. It is no longer just a warning shot. It becomes a test of credibility. Credibility is fragile in currency markets because exchange rates are not only moved by trade flows and interest rates, they are moved by belief. If investors believe Japan has the will and the ability to defend the yen, they are more cautious. If they believe Japan is defending a level that cannot be sustained, they become more aggressive. A failed intervention is worse than no intervention because it reveals the state's limits. It tells the market that billions of dollars were spent and the pressure still returned. That is how a currency defense can accidentally invite the very pressure it was meant to stop.
Japan's situation is especially difficult because every available option has a cost. If Japan allows the yen to weaken, imported goods become more expensive, and the pain falls directly on households. Japan imports much of its energy, so a weak yen raises the cost of oil, gas, electricity, transportation, food, and industrial inputs. That matters even more in a period of geopolitical tension, especially if conflict in the Middle East or disruptions in shipping routes push energy prices higher. A country that imports energy suffers twice when its currency weakens during an oil shock. It pays more because energy is expensive in dollars, and then it pays more again because dollars are expensive in yen. If Japan raises interest rates more aggressively to support the yen, it creates another problem. Japan has spent decades living in a world of very low borrowing costs. Its government debt is enormous, its financial institutions have built portfolios around low rates, and its property and equity markets have adjusted to cheap capital. Higher rates may help the currency, but they can also stress the bond market, raise government financing costs, pressure banks and insurers, and weaken parts of the domestic economy. A strong yen purchased through aggressive tightening may come with financial damage at home.
If Japan relies too heavily on intervention instead, it spends reserves and risks giving markets a target. Japan's reserves are large, so this is not a story about running out of money overnight. The danger is more subtle. Repeated intervention can make the yen look less like a floating currency and more like a defended line. Traders love defended lines because they create a clear test. If Japan seems determined to defend a certain level, the market can push toward it, watch the response, and then judge whether the defense looks credible. The more public that battle becomes, the more political and psychological pressure builds. This is where the issue becomes global. Japan is not a small emerging market defending a fragile currency with limited reserves. Japan is one of the largest creditor nations in the world, and its savings are deeply connected to global bond markets. Japan has long been one of the largest foreign holders of U.S. Treasury securities. When Japan supports the yen by selling dollar assets, the immediate operation may be manageable, but the broader message matters. If investors begin to believe Japan may need to sell more foreign assets, or if rising Japanese yields encourage domestic investors to bring money home, the effect can reach far beyond Tokyo.
The risk is not a cartoon scenario where Japan suddenly dumps all its treasuries and crashes the global financial system. That kind of claim is dramatic, but it is not the most serious argument. The more realistic danger is that Japan becomes another source of pressure in an already sensitive global bond market. If U.S. deficits are large, treasury supply is heavy, geopolitical risk is rising, and one of the world's biggest foreign holders of dollar assets is under pressure to defend its own currency, global liquidity can tighten at the margins. In financial markets, the margins matter. They are often where stress first appears. The Japanese government bond market is another place to watch. For decades, Japan's financial system rested on the assumption that government borrowing costs would stay extremely low. If the yen keeps weakening and the Bank of Japan is forced to tighten more than expected, Japanese government bond yields could rise in a way that changes the entire domestic financial equation. Higher yields may attract money back into Japan and support the yen, but they also reduce the value of existing bonds and increase the long-term cost of servicing debt. Japan's fiscal position makes this trade-off more serious than it would be in a country with a smaller debt burden.
The household side is just as important as the market side. A weak yen creates imported inflation, and imported inflation is politically poisonous because it feels unfair. People do not experience it as an abstract exchange rate adjustment. They experience it as higher grocery bills, higher utility bills, more expensive fuel, and a general feeling that life is becoming harder while wages are not catching up quickly enough. In an aging society, that pain becomes even more sensitive because many households are living on fixed or slowly growing incomes. A currency crisis does not need to involve bank runs or dramatic collapses to become politically dangerous. It only needs to steadily reduce purchasing power. This is why the manufacturing question matters so much. In the past, a weak yen could be seen as a gift to Japan's export machine. Japan once stood at the center of global manufacturing prestige. Its cars, electronics, machinery, cameras, components, and industrial systems helped define the modern global economy. When the yen weakened, exporters became more competitive. Foreign earnings translated into more yen, and the pain of higher import prices could be partly offset by stronger corporate profits.
That logic still exists, but it is weaker than it once was. Japan remains a major industrial power, especially in autos, robotics, precision machinery, specialty materials, and high-end components. It is not an economic museum. It still makes things the world needs. But it is no longer the broad manufacturing hub that China has become. China now dominates global manufacturing scale in a way Japan no longer does. That changes the meaning of a weak yen. If a country has an enormous export machine ready to convert currency weakness into global market share, depreciation can look like a weapon. If the country is older, more dependent on aging energy, and less dominant in mass manufacturing, depreciation can start to look more like a tax. This is one of the most important ways to understand Japan's current vulnerability.
The yen is weakening in a world where China has already absorbed much of the manufacturing role Japan once symbolized. Japan cannot simply devalue its way back to the 1980s. A cheaper currency may help Toyota, machinery exporters, and companies with large overseas earnings, but it does not automatically rebuild the broad industrial dominance Japan once had. Meanwhile, the costs of a weak yen arrive immediately through imports. The benefits are uneven, while the pain is widespread.
China's rise also changes the geopolitical meaning of Japan's currency defense. Japan is a close U.S. ally, a major technological power, and an increasingly important security actor in Asia. Its economic stability matters not only for markets, but also for the balance of power in the region. A Japan under currency pressure, energy pressure, and household inflation pressure has less room to maneuver. It may need to spend more on defense, while also supporting households and managing debt costs. It may need to strengthen supply chains while paying more for imported raw materials. It may need to compete with China while depending on a global trading system that is becoming more fragmented and more political. That is what makes the current moment so different from a simple exchange rate story. The yen is being pressured during a period when the world is becoming less forgiving. Energy markets are exposed to war and shipping disruptions. Trade policy is becoming more nationalistic. Supply chains are being reorganized around security rather than pure efficiency. The United States is carrying large fiscal burdens. China is exporting industrial pressure into the rest of the world. Europe is dealing with its own growth and security challenges. In that environment, Japan's intervention is not happening in a calm global system. It is happening in a system where many pressure points are already active.
The warning signs are not hard to identify, but they need to be read together. The exchange rate itself matters, especially if the yen weakens quickly through levels that markets treat as psychologically important. Japanese officials often focus less on a specific number and more on the speed and disorderliness of the move. But markets still watch round numbers because they can become magnets for speculation. If the yen moves sharply toward or beyond levels that previously triggered official concern, intervention risk rises. Official language is another indication. Japanese authorities usually speak carefully before they act. Phrases about watching markets closely, responding to excessive moves, taking appropriate action, or acting decisively are not random. They are part of the signaling process. The stronger and more frequent the language becomes, the more the market begins pricing the possibility of intervention. This language does not guarantee action, but it tells investors that officials are uncomfortable. Money market data can also reveal suspected intervention before formal confirmation. Japan may not immediately announce the exact timing of every operation, but large movements in official accounts can give analysts clues. This is why traders watch settlement data, current account balances, and reserve figures. Sometimes the intervention is not declared loudly at first. It shows up in the plumbing.
Foreign reserve data matters because intervention is not free. Japan has large reserves, but the trend is important. One intervention may be absorbed easily. Repeated large interventions raise a different question. If reserves decline meaningfully while the yen continues to weaken, markets may start to doubt the effectiveness of the strategy. The issue is not only the amount of reserves remaining, but whether the spending changes the market's behavior. A costly defense that does not change expectations becomes harder to justify. Japanese government bond yields may be even more important than the exchange rate. If yields rise because markets expect the Bank of Japan to tighten further, the pressure moves from the currency market into the domestic debt market. That is where the story can become much more serious. A currency can move violently and still remain a market story. A government bond market under stress becomes a national balance sheet story. Oil prices are another critical signal. A weak yen is painful enough. A weak yen combined with rising oil prices is far worse. If geopolitical tensions push energy prices higher, Japan's trade balance, household inflation, and corporate margins can all deteriorate at the same time. That combination creates political pressure for intervention, fiscal subsidies, and monetary caution, which can pull policy in conflicting directions. Real wages and consumer sentiment should not be ignored. Currency weakness becomes politically explosive when households feel poorer. If wages fail to keep up with import-driven inflation, public frustration grows. That can pressure the government to act even when the economic logic is complicated. Markets often underestimate household politics until it is too late, because traders see a currency chart while voters see a supermarket receipt.
The U.S. Treasury market is also worth watching because Japan's choices can affect global capital flows. If Japanese investors can earn better returns at home as domestic yields rise, they may hedge more, buy fewer foreign bonds, or repatriate some capital. If authorities sell dollar assets for intervention, that can also affect liquidity at the margin. None of this means an immediate crisis, but it does mean the yen cannot be understood separately from global bond markets. The most dangerous scenario begins with a geopolitical shock. Imagine energy prices rising because of conflict in the Middle East or disruption in major shipping routes. The yen weakens as Japan's import bill rises, and investors continue favoring higher-yielding dollar assets. Japanese officials intervene, and the yen rallies for a short period. Then the pressure returns because the underlying rate gap and energy vulnerability remain. Markets begin to test Japan again. The government intervenes a second time, perhaps even a third time, but each operation buys less time. The Bank of Japan faces pressure to raise rates, yet higher rates threaten the bond market and the fiscal position. Households continue facing higher prices, companies become cautious, and investors start reducing risk. In that kind of environment, Japan's currency defense can become a symbol of a broader loss of control. The state may still have the tools, but markets may question whether those tools can be used without causing damage somewhere else. That is the essence of the trap. Supporting the yen through intervention can burn reserves. Supporting it through rate hikes can stress the domestic financial system. Not supporting it can deepen imported inflation and damage household confidence. There is no painless option. This does not mean Japan is on the edge of collapse. That would be a lazy and exaggerated conclusion. Japan remains wealthy, technologically advanced, institutionally strong, and globally important. It has deep financial markets, large external assets, world-class companies, and a society that has endured long periods of economic difficulty without losing basic stability. The danger is not sudden national failure. The danger is slow constraint. Japan may discover that it can still act, but every action costs more than it used to. That is why the yen intervention story is meaningful. It is not only about whether USD/JPY moves up or down tomorrow. It is about whether a country built around low rates, high savings, industrial strength, and imported energy can navigate a world of higher global rates, geopolitical fragmentation, Chinese manufacturing dominance, and domestic aging. The yen is where these pressures become visible because the currency condenses everything into one price. Interest rates, trade, energy, demographics, fiscal trust, investor confidence, and geopolitical risk all meet in the exchange rate. Japan's intervention may succeed for a while. It may scare speculators, slow disorderly moves, and give officials breathing room. In some cases, that may be enough. Markets can overshoot, and governments are justified in pushing back when price action becomes disorderly. But if intervention becomes frequent, expensive, and ineffective, it sends a very different message. It suggests that Japan is not merely smoothing volatility, it is defending an economic model under strain. The hardest question is not whether Japan can buy yen. It can. The harder question is what Japan is buying with that intervention. If it buys time for wages to rise, inflation to stabilize, energy prices to calm, and monetary policy to normalize carefully, then intervention may be remembered as a useful bridge. If it buys only a few temporary rallies while the underlying pressures grow, then it may be remembered as an early warning that Japan's old assumptions were breaking down. A currency defense becomes dangerous when it stops looking like strength and starts looking like anxiety. Japan's challenge is to prevent that shift. It needs markets to believe that intervention is a tool, not a desperate habit. It needs households to believe that inflation can be managed. It needs bond investors to believe that higher rates will not destabilize the fiscal system. It needs allies to believe that Japan remains economically resilient. It needs competitors to believe that Japan is still capable of adapting to a world where manufacturing power, energy security, and financial credibility are being renegotiated at the same time.
The yen is therefore not just a currency. It is a pressure gauge. When it weakens sharply, it tells us something about Japan, but it also tells us something about the world around Japan. It tells us that capital still flows toward yield, that energy dependence still matters, that aging societies face hard trade-offs, that industrial power is shifting, and that even rich countries can find themselves defending the value of their money when the foundations beneath that value become less secure. Japan once showed the world what a modern manufacturing superpower could look like. Today, its currency struggle may show the world something else. What happens when a wealthy, advanced, aging country tries to preserve stability in a global economy that no longer rewards it in the same way? The intervention is the visible event. The deeper story is whether Japan can adapt fast enough to make that intervention credible.